for reading through those disclaimers. As I said, my name is Natalie Beckett, and I will be your moderator this afternoon for another one of GT's free educational webinars. We also have Andy Aronson with us. He's on the team over here, and he's going to be introducing Bubba and taking any questions you guys have throughout the webinar. Andy, are you with us?
I sure am. Thank you very much for having me, Natalie, and welcome, Bubba, if you're there.
He went home.
He went home? Okay. Well, I guess I'll try to mimic you, but I can't do that for more than five seconds. I can guarantee you that.
Always happy to be both here. For those of you who are just coming on, please make sure to test those speakers. I'm going to go ahead and give you the reins, and maybe, Andy, you can just sort of introduce him while he's taking control and pulling up his presentation. If Andy has questions during the webinar, please put them in the Q&A or chat box, and Andy and myself pass those over to Bubba. All right, go, Bubba. Pull up your presentation.
I got it. How's that? Can you see it?
Wonderful. I can see it. Andy, why don't you take it away, and then we'll get going.
Hi, Bubba. Well, thanks again for coming on with us. I think you're doing at least 1 a month with us, so everybody keeps asking when you're going to be on again. So we enough to have you tonight, and I'll let you just go right into it. And as we get questions, I may interrupt you and have those questions answered for the people attending the webinar.
No problem. And what's up, everybody? Always great to spend some time and share some time with you guys. So tonight, discuss how to use the seeding stock to exit options. That's the actual tongue twister I'm trying to get to. And it's a very valuable tool. Those of you who've heard me speak before know how important it is, and use the underlying is very important. But before I can go on, I'm forced to show this camera, but I'm not going to read it. But if you'd like to, please feel free to. So in the meantime, I'll give you about 3 seconds because you've already seen enough of these. So the greater the success is the fear of failure. And again, this is a that we're going to talk about, especially now with the markets going crazy the last few days. And you traded today or watched the markets today, you saw how wild the trade was, how wide some of the bid offer spreads were in options, and this is a way to get around it. So quickly, those of you who don't know me, and it's hard to believe you couldn't possibly know me, but I've been doing this for 38 years, and been all 3 exchanges. I'm still a member of the Chicago Board of Trade, or the Merc, whichever you want to call it now, because to me it's the same. I'm the founder and author of Bubba Trading, Bubba's Guide to Trading Weekly Options and Trading Weekly Options Handbook. I wrote that with my son. And I'm contributor to Fox Business, CNBC, Bloomberg, BNN, RFD, and Phoenix CB of Kick China. And if you're up now at 5:45 Eastern, you can watch me on Fox Talk Oil. And I also have a radio show every day from 4 to 5 Eastern. It was one of the original market makers in the S&P. What we know is the S&P used to be the SPX. Today, we're about using stocks to exit an options position, recognize value and parity, breaking down parity, how to long calls, how to close long puts, use the stock, the benefits, and then I'll take all of your questions as always. So, if you use stock to exit an options position, what you're finding out is how can you take advantage of the market without the market taking advantage of you. Okay, you actually save a lot of money exiting a trade, especially after markets are closed. Like for example, tonight, Disney and Akamai and some others reported earnings. And if those stocks would have moved enough to using the stock, we could have exited through the stock in the aftermarket and then used the options tomorrow to exercise out and take the stock position off. So what you're doing is you're locking in a profit. You're getting the ability to trade options when the markets are not traded. And understanding how to control underlying is one of the most valuable tools you'll ever learn in your life. In fact, a lot of trades I like to make is involve using the underlying because it gives you more power and an easier exit should you need to be able to get it out. We also sometimes will catch the miracle trade. And last week we did a trade in Facebook, and somebody said, it's like $8 in the aftermarket. Should I get out? And I said, well, we wait. And it went up 18 from there. So it was like we could have got out and had that happen, and that does happen. It doesn't happen every day, but it does happen. What you have to understand is how to recognize the value of the stock and the option and the relationship between the two. Because when you're looking at they have obviously intrinsic value and extrinsic value. And as we get closer to an expiration, the extrinsic value starts to fade away, the premium starts to fade away. But there are times when it will move a lot, and you can't necessarily get with the options. Like if you watched yesterday, the market moving so wildly that the bid-offer spreads, like even the SPY, which is one of the most liquid options on the board, had a ridiculous bid-offer spread. Now, to exit a position and knew how to use this strategy, you simply either bought or sold the stock, depending on what your position was, and that would have removed your position, and you've gotten out at what we call parity, which is actual real value. And you look for is a parity exit. So parity is not only a situation of equality. Parity can occur in many different contexts, but always means that two things are equal or official value. You know, if you look at any option, especially, they all have parity because on expiration, the options are either worth something or it's worth nothing. If it's worth nothing, they abandon them. But if it's worth something, then when it closes at parity, which is the real value. To make sure that when you see markets getting a little bit away from you, that you have this arrow or tool to do with, because you won't get trapped where market, like you'll see markets on expiration Friday. If you have a stock that's $100 and you own the 95 call, well, the 90 call might be $4 bid, which is worth $5 at parity, and a $6 offer. So if you want to, you could just simply sell stock, which is the same thing as selling the call. It's very important, the parity value and the official value. So 120, the stock is trading at 124. So parity would be $4. The closer we get to expiration, or the deeper in the money the option gets, the more it becomes parity. That's, if you remember the term delta start like to trade 50 delta options, but as they get deeper in money, they get about 80 or 90 or 100, and that actual full value. And if you can't get out through the actual option, then you get out through the stock. Parity occurs usually on expiration or slightly before if the option is deep in the money. Because know that many of these options will be exited on expiration and will price above and below parity. And some are not going to give you a break. That make their money. They give you crazy markets, and if you happen to put in a market order, you're not going to be very happy. Fall was 360 bid and 40 offers, so it was 80-cent wide market, 40 above and 40 cents below. Market are people that send in market orders and arbitrage the stock on immediate profit, which is what we're going to do, because we're going to take that tool away from the market maker. We are going to exercise the stock and create our own arbitrage for a day, a week, or whatever time it happens to be. Because the one thing we know for sure, as long as we control the right to do something, and simply do our trade, because we're in jeopardy, we want to put and we sell the stock. We're covered all the way down. If we buy the stock, if it goes to zero, we own the put, so we own the right to get out at that price that we own it at. If we long a call and we stock, we have the right to buy that stock. So that you have to remember. That's how we can lock in a parity trade. Graph here. So the price is 124. The one that makes parity value $4. The bid offer is 360 to 440. So if we want it, we could sell the stock at 1.4, sell it short. Real sale of the call is $4. Because what you'd have to do is then exercise your right. If you right away, you could. I would not recommend it. I would wait, because you can get it. There's good things that can happen from this. But you raised a $4 mark on that, which is what you're trying to get anyway. So now you've got $4 in action, and the is over with one exception. Okay. Short the stock, and at some lucky break, the stock's down $8 after you ordered it. Well, you did your $4, and you can make an additional $4, because once the stock goes back down to 120, for $1 on the stock on the short side. So you get the opportunity to make money on both sides. And again, in markets like we have today, the last 2 days for sure, the opportunity arises, and you get to put this trade on with no additional risk to your equity. And you have to clear this with your broker, Most will not charge you as long as you maintain and hold the rights. They will charge you a margin because obviously if you're in a stock like Apple, which is $160 now, every 100 shares is $16,000. You might have that in your account. But if you're a broker and you get approved, they may, some do and some don't charge margin because they know they have the right to control the stock because you the option in your account. Now, if you get a put at 21.24 and you have 130 put, okay, it would make parity value of $6. The market bid offer is $566.40 again, 40 cents off. Not like much, except it's $40 a contract, which is to me a lot of money. And then it gives you a net of a $6 profit. Okay. Now this trade really comes in handy during earnings season, and again, these wild markets it comes into play because you get things that you can do to execute a trade that you can't seem to get filled. A lot of times we have trouble getting filled at a price. You simply the stock if it's deep enough in the money and go right from there, and then you increase the chance of your profit and the chance of making more by controlling the underlying. So the December expiration corporation trading at 70.70, and you own 20 of the December 65 calls. That would look closest out. The December 65 call should be trading at very near to parity, which would be 570. However, as you know, they changed the markets and they know what's going to happen, so they're going to stop you from getting that price. If you go to stock, you get money, you get paid, and that's the important thing that we're always looking for is opportunity to make money. Okay, so call options, you stock. You buy stock. Because on the other side of that trade, right to exit anytime you want. You have to exercise. We only American style options, so we can do it anytime we want. Now, again, I not exercise immediately because I want to hold on to it. I already know I've locked in my profit, and my profit. Should I be in a hurry to stock? Because it won't affect anything, and the only place that you can't hold the stock in is IRA account because you can use margin in an IRA, and this will require margin. But you get to either buy stock or sell stock, and of course you can do that through and after the close because most equities trade till about 6 o'clock or 7 o'clock Eastern time. So something crazy goes on in the market in one of your stocks, and you've got a position, then you can certainly use the stock right then. And again, we use it a lot in earnings because these typically come out after the market closes or before the market's open. So if you have a position you want to exit and you have on a 2 back ratio spread, you can lock in 2 years profit by either buying or selling the stock. We'll get in right now and open up to if the stock happens reversed. We've never seen that before, right? Where the stock goes up after earnings, and by the morning it goes straight down. You can actually benefit from that action because you've now changed. You've locked in a profit. You haven't changed the dynamics of your trade, but now you have the other side, which is now unlimited because it is the underlying security versus just an option that can only go to zero. It creates a lot of action for you, and you get to these deep in the monies. Remember, what happens with deep in the money options? They all become a little bit more illiquid and harder to trade as well. So trying to fight around with the market makers, simply go ahead and say, okay, let me just bang the stock, either buy or sell it. And so, again, closing call positions, you use short stock, closing option, you long stock. Being the exercise the right on the other side. Because if you remember, options are rights and obligations. So if we own the right, then we're not in any jeopardy. And if we make $2 or $3, we can lock that in any time we want. And again, this will come in handy with that we're trading right now that are so wildly flying around. I mean, if you look at some of the big spreads right now, see some stuff that's pretty amazing actually. Looking at last night, I was looking at some spider options. I wanted to buy some calls, just an inexpensive play, but there was nothing that was inexpensive because these markets are. Look at how wide these markets are now. These are usually 1 or 2 cents wide. and they're getting out, and during the day they're getting out to wide on occasions. So it's easy to use to get out. And another one that just happened to happen overnight was Skyworks, Sierra Whiskey Kilo Sierra, and blew the door up on earnings. Now, you had a position here that was a long call. You could have shorted the stock at, let's say, 107 and looked in your profit immediately. And the nice thing about this is, if you use like a one-lot trader doing a 2x3 or where the ratio is, you can actually sell any portion of the option. You can sell a half of an option by using 50 shares of stock. You know, we all get to that key decision when to get out. Okay, and you start to get itchy and you're not sure. Well, it's always hard when you only have one. It's like you're giving up your final bullet. Well, now learn how to use the stock. You can sell shares, so you're going to sell a half of an option, or 60 shares, or 40 shares. So you a whole new stock to play with when you're doing it. And the same thing happens on the call side. Again, you're going to have more money if you know how to use the or the underlying, because when I was trading on the floor, probably one of my favorite trades was to, buy stock or sell stock and then do a ratio by buying or selling extra options. All right. So something that you have to start to recognize, because first of all, it will give you a better sense of what value is and a better sense of what parity is, because these are things that many people take for granted, that understand the actual workings of the market and the workings of what market makers are doing. Market makers know one thing. They know that orders or paper is flowing into the market. And the markets are set based on order flow. And order flow is at times very challenging and very tricky for managers. So at times it's easier to either bottle the stock to get out. And again, if using any example, the line always comes down to it's about the money. All right, it's about how I get the most amount of money out of my position. So deep in the money put, okay, you can let's say the December 80 puts, they are being quoted at $9. Selling 20 of those would be $18,000. However, it's worth $19,000, but you get 18 on the open board. So by using the stock, you get out at a higher profit. And this is what this is about. It's about understanding where profit lies and understanding how the market itself works, and put yourself in the overall position without having to deal with the minutia when you have to go through some of these markets that they're thinner. And this really pays off if all of a sudden the liquidity is up. Today in the markets, the liquidity dried up. So if you're trying to exit, it's very challenging. And out because you've got a big profit, but it lets you out. So how? Well, you get out by using the stock. Okay, and just that in mind. You always, when you're exiting a call position, a long call, you're shorting the stock. When you're output, you're buying the stock. Right? Just remember, always markets when you're dealing with the stock, whatever it would do with the put is what you would do with the stock. This is like a part of arbitrage that they use, and this is what market makers use all the time on a daily basis, because they lock in dollars. But we're not looking for dollars. We're looking for much bigger positions. Now I know that Disney. So let's see what Disney did. Okay, so Disney is 108.53. Okay, the stock opened around 103. So say you had a position on here, and you needed to make $2 to break even, but now you sold at 108.53. You could make $5. But the bad news is you can't trade the option right now. You do. Well, you sell the stock short. Real 108, or you had the 103 call, 550 on that call. You only made $3.50, but you have now locked in profit, and the trade is over. News: if Disney decides to tank for tomorrow morning and go down to 101, you already sold it at 108, so now you make $7.50 on the downswing. You the initial $2 risk you have, so you make 5.5 instead of 3.5. Not going to happen often, but especially around earnings and especially around markets that are acting like they now, they're pretty crazy. You've had some pretty wild swings in the market today. You look at the spiders, for example. The spiders $12 range today. Guarantee if you were trying to get out on the open this morning at 9:30 on some short position, you were having some trouble because it was spiking straight up. Well, guess what? If you would have had that, you just bought the stock early, then you long the stock and long put. All right, so you're keeping the money, you're not losing anymore, you're locking in a profit. And God forbid the stock should collapse tomorrow, we should go back into the same bear market we were yesterday. You can make a lot of money. Okay, and understand that, how that works, because again, a better way, the trade will have no effect on your equity. You will be in the exact same position as if you had paid the market maker the extra premium for your priority call. All right, just change what you do. Okay, now, very important. We retail traders are not market makers. You cannot afford to try to play market maker. If you do, you'll find yourself deep in your pockets more money, because we are not able to compete with the market makers because we don't have the advantage of the order flow or coming in and being able to adjust around it. This is why this is another strategy that you have to be prepared to use. And I will say this to you, this will be the most valuable tools that you will ever learn in life if you get yourself to learning this. The fact that you will on your own account, and that you've seen a stock, have we ever seen a stock that's just going our way in the aftermarket and going our way and going our way, and we go, God, I hope it's that way till tomorrow morning, and the tomorrow comes and it collapses, all of a sudden it's not going anywhere. No, then what do you do? You go, all right, now you have an exit to get out of that stock, and you can do partial, you can do the whole position, because you lock that in, and it comes into play in all times. And eventually, if you ever learn, you can learn to use the same thing with the underlying and the futures against a spot. It's not for today, but that is another thing. For example, on the night that Trump won the election, the market's limit. If you had something on, you could have gotten out to the futures market that night. In other words, it's learning how to control the insecurity. And that's the most important thing you can learn, is how to control that. And what's, okay? Now, best possible returns on your options trading. It is important to understand how options work in markets in which they trade. You're going to step in to liquid as some, then you definitely have to use the underlying. Okay? And I would recommend to you that you know how to use the underlying, because you may trade a stock that is maybe not as liquid as you like. Now, I don't mind giving an edge on one side of the trade if I have to, but I'm the edge on both sides. And if you're trading something that doesn't have much liquidity, you end up with giving the edge up on both sides of the trade and get screwed. And it's all about, you're trying to figure out the best way. So the best way is to learn the strategy that goes along with it. So if you do a buy-2 rate spread, a liquid stock, well, you can maybe sell 100 shares of stock and buy 2 calls, or sell 100 shares of stock and buy 2 puts, depending on which way you're playing it. Now, you only giving up the edge on one side of the trade. You can underline, and what benefit about the underlying? Well, an option, it can only go to 0, right? Stock, I can 0 too, but usually it's a little bit farther than the $2 you're getting for the option you're selling. So now the thing can go down forever. Your no exposure if it goes down, but in you make dollar for dollar with the stock once you've covered your net risk. And bottom line of understanding how this all works. Now, as a normal closer positions with the intrinsic value, you should ever close below intrinsic value. Many of us are lazy and don't say, hey, the first thing you want to do, comfortable with the stock, is go to the option. So if parity is $4, okay, so I'm up a penny, so I'll offer it at $3.99. If they don't take it at $3.99, I'm going right to the stock. I'm not going to give in to the market because I don't have to, because I have my own tools that work. Don't what you've accepted in the normal course of business. the others make enough money. They don't need to steal a little any more from us. So if we learn to use this tool, then what you're yourself doing is you're going to find yourself picking up an extra, $50, $60, $80 a trade, or losses by $50, $60, $80 a trade. And by the end of the year, that adds up to be a lot of money. Not to mention the opportunity that you've created. Okay, and you do this, and the extra opportunity is guarantee within the year's period of time, you're going to get a reversal in the stock that's going to go in your favor, and it's going to go in a big way. And the other start to learn is that sometimes you want to make these positions and trades on using stock as part of the trade. If you're using the stock as part of the trade, it gives you a much bigger upside on your, because again, when shorting an option, that option can only go to zero, or using the stock and shorting the stock, that stock can go down a lot farther than the zero that you could get. Something that is important for you as a trader to put yourself in the best position without adding any more risk to your trade. And I think something that you have to remember as well is what is the risk, because at the end of the day, money. All right. Now, would have made you an extra $1,000. Okay, and that's the important part. Again, we don't want to give up any edge. We already have. We are giving up an inherent built-in edge that is meant for the market makers. I want them to make money. There's nothing wrong with them money. I just don't want them to make too much of my money. So, next market maker for 38 years, I understand all the ins and outs of how these trades work, and I'm telling you that this is the most important strategy you will ever learn, because we find out is that markets trade at any time will give you opportunity, and you can't get out through the option. You can use the stock to get you out, and that makes your job and your life a lot easier. And I know we had Akamai report tonight. I don't think it did anything, but let's just take a quick peek at it. Is up from the close about $4. So if you put something down here, you can realize a profit up here. Okay, again, I'm redundant, but understanding how to use this, it's been very hard for me to explain to everyone sure that they can understand, and it doesn't change the risk of the trade. Remember, the firms with the day electronic markets, they're going to go over margin. So that you change all of a sudden from a position that's covered up to a position that is now uncovered up, right? If you're going to be short the stock, you're going to have a long call for that stock up. If you're going to be in the stock, you're going to need a long put to cover up that stock. So again, the way that the computer systems work now, they're not giving you anything that you're going to give up. So you have to make sure that you understand how it's for you, and that is using the underlying, where you can use partial positions for partial exits or full exits. Or if you've got more positions on, you can use any portion thereof, because the stock or the underlying security is what we call has the power. All right, and the hidden power is you've now your risk the same. You've 99% of the time you've locked in a profit. And now you advantage of if something changes. Now, I urge you to watch NVIDIA on Thursday. They have earnings come out, and I just want to show you if I can last week. Okay, very interesting. When it first opened, let's see. Does that give me enough time? When it first opened, okay, it went down to 13. Okay, you should have bought it there. I didn't do that trade to analyze it. But down to 1380, and before the aftermarket was closed, it was at 1480. Now, and you could have bought stock at 1380 and went at 1480 and made $100 on the stock. And all of the time, anything that's going to report earnings, you typically get a lot of two-way action and movement that is going to benefit you over time. And you'll see this, like I said, NVIDIA, because those are the ones, Netflix and NVIDIA, and it's like that are extremely volatile to begin with, will give you a bigger opportunity to watch it. But again, learn how to using this, you're going to find yourself in a much better position and be able to exit and never miss that winner that was last night before you went to bed. It was a big winner, and by the time you got up, it was a big loser because you couldn't get out. And we had this MGen a couple of last earnings, and the stock was way down in the pre-market, and bought the stock, and the stock then went way up right afterwards, and you would have made money on both sides of the trade. You would have locked in your profit on the short side, and then this one side you would have made the money on the long side. And this is the importance of understanding, and this goes back to understanding the security, the relationship it has to the option market, and then be successful at using that strategy. It simply means that you understand what your risk is. So if we did a trade right now, Disney, because it reported, so the odds are going to be priced on today's value. So let's just do this real quick.
Okay. One good question for you,
yeah,
from one of the attendees, and he's asking on the VIX, which is just a cash index, you could not do this strategy, correct?
There is VIX options, but you can't do the strategy, nor would you want to. I urge you all to stay away from the VIX. It's always skewed improperly. It's really a professional thing. They do have VIX futures, so you could use the futures as underlying security. I don't recommend it. First of all, I don't trade it myself, but it could be used because VIX does have a future as well.
It correlates to those options pretty closely?
Yeah. Fine.
Okay.
All indexes, that's a good question, though. All indexes, the Qs, the IM, the DA, they're also get a 5-to-1 ratio to the underlying future. So if you had SPY on, and you were long 5 calls, all right, and they were skyrocketing at night, and the market was already closed, and you couldn't do anything, well, you could actually sell one future if you have a futures account and take profit that way. But meantime, they all have a direct correlation to the underlying. That is the one thing, and that's why we stay away from the leverage products, because we can create our own leverage. Any of you guys that were involved in that XIV, I don't know what happened to that, right? Not a pretty picture. But meantime, so did Disney coming in today. So let's just say we did a 106. Wow, I didn't realize it really that much. So a 107 back ratio, and just do this and see what we get. 102 debit, so that's very good. So let's see if I just move it to the 108 real quick. And so now I need to send credit, but I get $3, so I need to get $6. I need to get $500. So the stock has to go to 113. Well, the stock is not at 113; it's at 108. So I would have no trade here. But if I had if I had options on that would benefit at 108, then I could take profit right now. And that's the beauty of understanding how the option model works in comparison with the, because again, they're actually correlated, and that's where the volatility and everything comes into play, is the direct correlation between the options and between the stock and how they're together. Okay. So with these, as you go through, and I urge you to watch some of these big company earnings, because those are the ones that are most likely to have the wild moves, where you have the chance to get the two-way movement. These all worked. I mean, Intel last month went up $5 after the market closed. You could get out of the stock right away. And that's the importance of how to understand and how these all work for you to give you this opportunity to succeed in this market. And that is what we call the hidden power of the underlying security. It's a big deal, and it's something I urge you all to work on. We've worked on it, with my crew for a long time, and it's not the easiest thing until you understand it. And once the light goes on, then it's ready to rock and roll. And it doesn't mean you're always going to use it. At least it's a tool that you can use. You got any candy?
That's slowly but surely. I'm handling what I can, but I thought that would be a good one for you.
Because again, this is something that you just have to remember that if you own a put and you want to stock, okay, you have to stock. If you're call, you get stock. Okay, the put member, because we have a put, whatever you're doing with the stock, you're always doing with the put. The old days of reversals and conversions, the way it was, whatever you're doing with the put, you do with the stock, and you don't have to deal with it. And you can remember easily. But remember what your right is. You have your right to exercise, and if you remember what your right is, then you have to do to capture the most amount of benefit. And that's something that we're looking for, is the best opportunity to get the most amount of money when we trade. And I'm telling you that over the last few years, it has cost us dearly on some trades we miss because we don't all understand this. And this is something that you need to understand, even just to understand the value below it. If you don't want to use it, but it will teach you more of the options model. And if you have questions about this, you can reach out to me, Bubba at trading.com, and you can always reach out to me by phone and do your thing. But again, we're always here to help. And again, I'm trying to give you the best possible tools to give yourself the best possible chance to at least minimize bad trades and maximize